So I want to talk for just a moment about why that's important, because I think it's going to help business owners understand out there why banks sometimes are unable to do a loan. And it's really important to me for all of you out there to know that banks do not make money if we do not make loans. So this notion that banks don't want to make loans is absolutely, positively false. I cannot pay my mortgage. I can't pay for my kids' braces or anything. If my bank doesn't make a loan, we can't be profitable. So C&F Bank, and frankly, all banks out there, want to make loans. And because we are recipients of depositors, federally insured deposits, and because we have shareholders, we do have a high expectation for the safety and the soundness of the loans we make. Now, for you business owners out there, that may mean that a candidate for a bank loan is a business that has been in business for a number of years. They have a track record of success. They can come into the bank and say, hey, here's my balance sheet. It's got assets, more than liabilities. They can come in and say, here's my revenue. Here's how I manage expenses. Here's my track record. And that's the kind of track record that most conventional financing candidates have. Now, the other thing that typical candidates for bank financing have are personal assets. They're putting their name and they're putting their guarantee behind this business. And when that personal guarantor, the owner of the business, shows personal financial strength as demonstrated by assets that they own, whether it's a house or cars or investments, money in a savings account, money in a mutual fund, money in retirement accounts, something that shows the financial strength of an individual, those are candidates who are typically well suited for bank financing. Yep. Now, what if you're out there and saying, well, Matthew, that's not me. I've got a great idea, but I'm just going into business and I don't have this track record. Well, what do I do? And yet there's still options for you as it relates to conventional bank financing. For example, is there someone who's willing to guarantee the loan with you? Perhaps a spouse or friend who has a secondary source of repayment. And by that I mean they've got a job at another company where they have a guaranteed or consistent paycheck. A bank will consider that. Perhaps you have collateral that would be suitable for the bank and put the bank in a position where they could justify the loan.
Or perhaps the friend or an investor has collateral that they're willing to put
or
up
perhaps
to
the
help
friend,
guarantee your
yes,
loan.
that's common as well. So, getting bank financing, it's not as tricky as it looks, but I'll admit it is a selective process because of that FDIC insurance that we provide to our depositors and because of the shareholders.
And I'd like to add one thing. Keep in mind that banks are very heavily regulated. They may want to make a loan. The loan may look good, but when the recession came along, all of you are familiar with how many banks got in trouble. So the regulators started paying visits to the banks and doing what they would call classify loans. Let's say the bank had made a loan with a piece of collateral, and that piece of collateral was worth X dollars when they made the loan. As the recession came along and more banks got in trouble, the examiners would come in, the value of that collateral had gone down, so the examiners made the bank set aside a loan reserve for that. And every dollar that they have to set aside in loan reserves is a dollar they can't make loans. So they have the shareholders, they have their fiduciary relationships to deal with, but they also have to be careful with the regulators. So they've got three things really watching over what they can do in terms of commercial loans. They may want to make the loan, but if they know the regulator's not going to like it, they can't make it.
That's a great point, Doug. In fact, I would tell you that having been in banking for 27 years...
You're not old enough.
I'm not old now. Well, you're very kind. Your vision's not very good now. I would tell you that back 27, 28 years ago, when we turned down a loan, it was because the bank really said,
Right.
you know what, we're not certain that this loan can be paid back. And now, sadly, many times we're turning down loans because we know the examiners, federal examiners that visit our institution, no matter how strong your bank is, they are there every year, can criticize a loan.
Even if it's been current.
Yep,
I used to
on
hear that all
time,
the
as
time. The
agreed.
borrower's paying their loan every month, but if the examiner thinks there's a problem with it, they hit the bank with it.
That's right.
And it's just not, it's not fair logically, but that's today's banking environment.